Welcome to the National Credit Awareness and Resolution Association podcast at NACARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use creditors' tools, specifically coming soon to an economy near you, the economy. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Seasons of default and restructuring. Facing a world of uncertainties and shock risk events, with balance sheets laden with too much debt, facing a world of inflation and high cost, higher interest rates, other uncertainties, and shock risk events, there will be a debt crisis. A debt crisis will result in economic turmoil and lead to seasons of default and restructuring. The banking world will have to greatly enhance its debt repayment strategies to include debt repayment plans prepared by its borrowers. In fact, debtors, not creditors, will lead the way for resolution strategies going forward, as the creditors will be unable to otherwise manage the caseloads. You, the borrower, needs to be on the ball, needs to be the one to call the shots on exactly how much and when you will repay on a best efforts and good faith basis. Your repayment plans will have to be fully transparent, documented, and reasonably supported. As such, regulators are likely to consider these workout plans as having been done in a safe and sound or prudent lending manner. Workout loan modifications are perfectly reasonable and expected by creditors. The debtor-prepared repayment plan may even include an orderly liquidation of assets, as that's often in the best interest of the creditors too. But these measures should be done right, within prescribed guidelines, and often under the direction and oversight of your legal counsel and that of the creditor. That's the purpose of these podcasts, to show you how regulated lenders, mostly, will likely be managing troubled loans. The marketplace will shift to having borrowers be responsible for preparing their own repayment plans during any of these seasons of default and restructuring. Next, let's talk about deteriorated asset quality metrics on the creditor's financial statements. With deteriorating asset quality credit metrics at financial institutions, it takes a lot of work and time for the creditor stakeholders to come up with the right repayment solutions. Creditors will need to seek additional exterior resources to service multitudes of underperforming loans. Don't count on the creditor's efforts to meet anyone's interests except their own. They will almost always put their interests first. You may get more attention for deal structuring when the creditor's credit metrics are still favorable. Like, for example, the creditor has the capacity to work with you. But if the creditor's credit risk management practices become criticized by the regulators, it's a whole different story. And many will be in that situation. They will often press you to exit your banking relationship with the creditor to right-size the creditor's financial performance. They are greatly concerned about their reputation and financial standing in the marketplace. The huge bonuses of senior and executive management are often tied to the creditor's financial performance. And troubled loans are like pouring a bucket of water on the fire each time a commercial loan becomes classified. The creditor's proposed repayment strategies may not be in your best interest, regardless of who is overly distressed. Don't be surprised if you find yourself in an automatic foreclosure or liquidation environment that mirrors the automatic quick approval you got in the first place. Miss a payment and you're in default, paying the default interest rate or worse, etc. As deteriorating financial conditions arise in the economy, ask yourself if you think you're going to get the time and attention you deserve, and if your financial institution's credit metrics become too stressed. You're not. So beforehand, now is the time to be prepared and get prepared. Maybe you'll be one of those who will learn the hard way that the time to prepare is too late and has passed. You can still pick up the pieces and propose your own repayment plan, assuming you know what you're doing. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at thetunabudget.com to tune into the Debt Crisis Problem podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. When loans are rated criticized or classified, these problem loans, due to deteriorated financial conditions. As you can appreciate, financial institutions are mostly regulated. Asset quality is often the big elephant in the room, commercial loans. Other risks include liquidity and interest rate sensitivity, as has been evidenced in the 2023 regional banking crisis. Concerns continue into 2024 and certainly into 2025. Most lenders are super experienced at understanding credit risk, structuring and monitoring your ability to repay pursuant to the terms and conditions outlined in promissory notes and loan agreements. Did you know that your loans are risk-rated accordingly? Once loans are criticized or even classified due to any deteriorated financial performance, the clock really starts to click to get to resolution. This means that your creditor's new objective is to get your loan's risk rating upgraded from criticized or classified back to a pass rating through adequate financial performance, or to a zero balance, through whatever means are necessary. Lenders are required to be prudent, though, and maintain safe and sound banking credit risk management practices. You will be required to fit within these so-called prudent terms and conditions. But where's your voice? Do you feel you have a say? Have you ever spoken up? Would you speak up and drive repayment solutions, especially if you're well prepared? Well, what are prudent terms anyway? Will your repayment plans fall within the walls of reasonableness? If you don't speak up or know what you're doing, you and the lender could be missing out on the optimum repayment strategies. Therefore, you must have your say as to what is appropriate in terms of your ability to repay. What you think matters. When you're prepared, creditors will listen carefully to what you have to say. The challenge is that debtors often fail to understand what and how lenders think, especially during sensitive periods of economic downturns when pressures start to build. Hence, lenders will often take your financial statements and tax returns and come up with a repayment solution they feel is appropriate for them, especially if the lender has a boatload of criticized and classified loans. Yes, the lender likely holds the superior cards in the deck, and you can force your hand, but it's your signature on the promissory note and the loan agreement. In other words, you have more of a huge say in these negotiations as the one who promised to repay, but you need to have the terms modified to fit your cash flow needs as you see them. However, you need to understand what the lender sees from his side and what he wants, so that you can show him what you intend to do. His conclusions may not actually be what works best for you at this time. The earlier you start this process, the better the results you should expect. Unless you understand why the lender is offering what he offers, better yet, if you understand what you need and can pitch the appropriate repayment strategy, you will likely prevail and stay in business. You want a win-win result that's in everybody's best interest. Now, are you a zombie business or not? So step up and speak up, especially in times of serious economic stress. It is imperative that you, the small business, stand up and be responsible for understanding, preparing, and recommending debt repayment solutions with your creditors. And creditors need your assistance, again, as a reminder, and a cooperative win-win relationship is being prudent, even if the numbers don't add up. But if your business is a zombie business, in other words, there's no way possible of repayment, then frankly it's dead. And a cooperative self-liquidation, often with the creditor's assistance, may be in everyone's best interest too. You'll have to decide if it can somehow be brought back to life. If you can get a pulse, you may as well approach your creditor, and the two of you will have to decide if your plan is prudent or nonsensical. Yes, it's important and in the best interest of lenders to prudently work with their debtors and accept your best good faith repayment recommendations. Again, though, in a downturn economy, it's unlikely creditors are going to be able to give you the necessary time and attention compared to those times when everything was going fine. You have to step up, even if you have a zombie business, and get resolution. Regardless of your situation, as a small business owner, be an owner and demonstrate it. Either way, you are capable and prepared, and do your best. Be willing to step forward and offer solutions to your own repayment problems on a best efforts basis. If you're a zombie business, there's only so much you can do anyway, right? Well, thank you for joining us. Today we covered the creditor tool coming to an economy near you, as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations at NACARA.org. If you found today's episode helpful, please subscribe for notification of future podcasts. Your feedback helps other small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.